And we are going to dig into some of the themes from the book, but I do want to just get your thoughts on this idea right now of American exceptionalism kind of driving the market rally. I'm curious, do you think that it is American exceptionalism, or is it that everywhere else, particularly when we look at what's happening in European stocks today, is it just not so great everywhere else?
Exactly. I think it's a combination of both, but I think that it's been amplified in America because in America today, the economy is about 26% of the global economy, but the stock market, depends how you measure it, is anywhere between 50 to 70% of the world's stock market capitalization. So I think that it's true that the rest of the world, especially like places like Europe, as I argue in my book, that capitalism is in even worse shape in the other Western nations, and so therefore that makes America feel a bit exceptional. But the stock market strength in America seems a bit exaggerated relative to its economic size. And this is mainly because there are a few handful companies that America has, particularly in the tech and the AI space, and the concentration of the S&P 500 has not been this high in recent history. So I think that's really what's making America, the American stock market, feel more exceptional than even the economy is.
And Ruchir, you're very much a veteran market strategist. I'm curious how you're viewing where things are today, valuation-wise, even relative to the rest of the world, compared historically what we've seen in the past, and maybe what investors need to know as to why we got here and how we got here.
I think that one of the key aspects here is to understand that the real issue that we have today is that some companies in America are earning supernormal profits, which is very high profits relative to what any capitalist society should allow these companies to earn. So the valuations are expensive, but the real story is not about valuations. The real story is the fact that you have these companies in America today, especially these tech giants, which are producing these incredible cash flows, incredible amount of earnings. And so I think that is what is very difficult to analyze the market today. But the classic bubbles that we spot is that valuations become very high. And so everybody looks back and says, hey, the valuations of the market today are high, but not as high as, let's say, the 99-2000 bubble. That's the typical reference point. But the big difference is that, like, how do you explain the fact that these companies are maybe over-earning, which is that normally in a capitalist society, you need new companies to come to take away the profits of the existing companies. But today, these handful of companies in America are earning extraordinary profits. And so that makes it very difficult, I think, to analyze what's going on. So the investor is saying, hey, the profits are great, valuations are high, but not that high, so we can keep piling onto these stocks. But the problem is that the earnings are supernormal high. And that, to me, is a real issue, with what's happening in America today.
Is the market just mirroring the wealth concentration that we're seeing there?
Exactly, absolutely. So the market's mirroring that, and I think that this broad trend, which again, we'll speak about in the book, is that the inequality in America, whether it's not just wealth inequality, even corporate inequality today is at record highs. And corporate inequality has many measures. One of them is in terms of the concentration. The second also has to do with the fact, where people are working. Today, if you happen to be working at one of the big companies which dominate in your sector, you're going to earn incredibly well. You're working anywhere else in that sector, your earnings are way less than that, than like in that one company. So it's like corporate inequality as well. But you're broadly correct that the stock market's incredible concentration is synonymous with what's happening in broader society in America.
Ruchir, you had a great piece in the FT. We were reading it out this morning. And I think the thing that caught our attention was ultimately when we talk about what is driving the markets, what is driving the economy here, not only in the US, from a global perspective, you talked about one piece of the puzzle, and that is politics. When it comes to the upcoming election, let's start with the US. I guess, how do you see the outcome of the upcoming election in November? What specifically do investors need to know when trying to gauge, I guess, what candidate might be? Is there a candidate that is better for the market than the other?
Yeah, so again here, what I pointed on the piece is this, that what is the one conclusion having looked at elections around the world? People keep looking at it, that, are coalition governments better? Which form of government is better? Are left or right-leaning candidates better? And here's the one conclusion that I reached in that piece that you were referring to, which is that typically the best returns in the stock market come in the first term of a new leader. And the longer the leader stays in power, the worse it is. I looked at America as well, and the gap is pretty huge. In the first term of a president, the stock market tends to return over 80%. In the second term of that president, the stock market tends to return closer to 30%. So that's a big gap in terms of what's going on. Why does that happen? typically when new leaders come to power, they have more energy, their policies tend to be fresher, and often they come to power with a mandate for making some changes. And that's what the markets tend to like. But the longer a leader stays in power, the more stale they become, which is why I don't think it's great news for America in terms of the two leaders we have currently fighting, because both of them are going to be there technically in a second term, very unusual second term, which is that in terms of that, for someone like Trump, usually you have terms which are back to back. This is a bit different. But from just that standpoint, there are many pieces of the puzzle, as you say. From that standpoint, a second-term leader typically doesn't tend to be as good for the market as, let's say, a first-term leader.
Yeah, a bit different is one way to describe it. But it's interesting because it mirrors this idea of there's a lot of pessimism across the country right now. And I thought it was fascinating the way that you start out the book talking and kind of comparing the economic situation in India that your family had noted to the US and kind of how that framed your thinking on American capitalism. What would it take for American capitalism to come back to an era that you think is more appropriate, is less kind of bifurcated in terms of a K-shaped recovery and a wealth gap?
Exactly. So I think that first, what I try to do in the book is that, as we say, the first step to a cure is to diagnose the problem. What is the problem? As I argue in the book, that over the last 100 years, capitalism in this country has been grossly distorted. It's been distorted not just by the increasing role of government as you measure in terms of government as a spending as a share of GDP, but the way the government is seen to be pro-business but not pro-competition. Typically, capitalism should be promoting churn and should be, the hallmarks of capitalism, that everybody feels that they have an equality of opportunity, even if the outcome is unequal, because meritocracy lives certain people. Today, the problem in America is what? 35% only 35% of Americans feel that they will be better off than their parents. That number used to be 70 to 80%. Like a couple of generations ago. So what a massive change that's taken place. So the average American is feeling that the system somehow is rigged against them, that they are not getting to benefit from what's happening at the headline level. And I think that that's leading to this massive amount of angst across the Western world, why approval ratings of leaders across the Western world today are close to record lows. So what I try in the book show is that how the habits of government over time. Government spending has gone up a lot, yet trust in government today is close to record lows. Then this whole government culture of regulating. Today, America institutes 3,000 new regulations a year. It's gone up a lot. And over the last 20 years, they have withdrawn how many regulations? 20 in total over 20 years. So, the average person is feeling that they are under the weight of this incredible regulatory burden. One statistic that I cite in the book, that today the average employee spends about 16% of their time doing things like legal compliance courses or other sort of courses which are just to meet red tapeism, not stuff which is productive. 16% of the time is going in just that. So I think that what I try and show here is that the government is concerned, the road to hell is paved with good intentions. So the government thinks that they're trying to fix problems, but every time they're fixing problems, they're creating more regulation. Their policies are, seem to be more pro big business, right. And also the fact that they're running these incredible deficits, which the average person sort of knows but doesn't know what to do about it. But their trust in the government is going down because they don't know whether the government will be able to be there to, in terms of fulfill their obligations.